Kendall, thanks for kicking it off, and thanks everybody for joining us today. It looks like there's quite a few folks on the call. My name's Dan Bernardo, certified financial planner here with Sentinel Benefits Group for the last 12 years. I'm also joined by a colleague of mine, Mike Dugal, also a certified financial planner here at Sentinel. And for today's presentation, we'll go through a brief agenda, but there will be some time for questions and answers at the end, as Kendall mentioned. Throughout the presentation, we're going to cover some high-level basics in terms of long-term care, what to plan for, things that you should be aware of or potentially looking into. As we go through, we'll talk about some of the financing options. How do we realistically, over time, either pay for long-term care? How do we prepare for the costs that may arise given a long-term care event, and some of the financing options through different types of policies that are available in the marketplace. And then ultimately kind of what to do from here in the event this is something top of mind. So that's the agenda. We'll probably answer a lot of the questions that you may have along the way, but certainly either during the presentation towards the end or as a follow-up with the dedicated financial planner you work with here at Sentinel. We're obviously here as a resource and can answer things that we may not cover throughout the presentation. So I'm going to let Mike kick things off to get us started.
Thanks, Dan. So really what we're going to start today is kind of giving a little background on long-term care, what it looks like, kind of the who, what, when, and where. And it's important, of course, to start with what is long-term care, what is a long-term care event for the purposes of this conversation. So really for a long-term care event, it comes down for the purposes of this conversation to ADLs, which are activities of daily living. So any of these, and you can see the list here: bathing, continence, dressing, eating, toileting, and transferring. Any of these would be defined if you're unable to do any of these ADLs, you'd be considered to be partially or considered to be on your way to a long-term care event. Now, there's different scenarios that lead to different situations within that. I think throughout this whole presentation, you'll definitely see that this is not a one-size-fits-all. There's a lot of different scenarios within a long-term care event, which we'll get into in a little while. But I think you're going to hear this term ADL, activity of daily living, probably a few more times throughout the presentation. So just wanted to start by addressing what exactly that means. And then if on this one, so also it's important to think about different causes of long-term care events. So I'm sure most of us on this call are probably, have had a loved one, a family member, maybe a parent, grandparent, a friend, something like that, who's gone through some sort of long-term care event. And as you probably know, there's a lot of different causes that can occur to create what we would call as a long-term care event. And really it breaks down to two different types. There's the physical long-term care impairments, be it, from a stroke, MS, just as someone ages, maybe their body's deteriorating a little bit, where they're still mentally sound, but their body is kind of failing them a little bit and they need that extra assistance. And then there's kind of the flip side of that. And this one, I think, can really be what is scary for a lot of people is the cognitive impairments, be it Alzheimer's, dementia, where the body is sound, but their mind is deteriorated significantly, where they are unable to care for themselves. And we'll talk more about the different types of care, but I think with the families that we work with, the cognitive is really what can be kind of top of mind, kind of the fear factor subject, because they tend to require much more substantial care and for much longer periods of time. But again, kind of just important to define those two as the two types of long-term care events. And then also we want to talk about the who, right? So a lot of people, like I said, you may know someone who may have had a long-term care event, but it may be kind of anecdotal, right? The grandparent, the mother, the friend, family, neighbor, but the statistics really don't lie on this stuff. And roughly 70% of people who are age 65 and older will have some form of long-term care event during their lifetime. And we'll dive into the different types, but I will say, going off this, statistically, women are significantly more likely to have a long-term care event. Not only is that because women tend to live longer than men, but they're also more likely to have a long-term care event, and also a longer stay when there is a long-term care event. So that 7 out of 10 people is skewed slightly more towards women, but still 70% or 7 out of 10 will have some sort of long-term care event in their lifetime. And then where can you receive long-term care? So it comes in a lot of different forms. I think a lot of people, when they hear long-term care, might think nursing home, a skilled facility where someone is living 24/7 under that 24/7 care. But that's not always the case. There's a lot of different ways you can receive long-term care. And in my experience, it tends to be kind of transitional, right? It may not start right away with someone living at a nursing home 24/7. It may start with someone coming in a few times a week, giving you kind of that extra help you might need around the house, maybe then transitioning to the assisted living, getting a little bit more care, and then it kind of progressing along the way from there. So there's different types of care available for different types of scenario. And then, of course, there's different costs associated with each of those that Dan will talk about on the next slide.
Yeah, so I think Mike did a nice job in terms of opening us up with the who, the what, the where. But ultimately, I think the biggest fear that most folks have is that, comes down to planning for the future, is the potential costs that can be incurred, whether it's for paying for insurances to protect against these potential future costs, or for folks that may not have the resources or the means, or they may not just have kind of the understanding of why protecting against these future costs are important. But this shows kind of a wide range of kind of that where in terms of how the costs can vary. So for different people, there's all different needs. These costs are specific to Massachusetts. So obviously for folks that are out of state on this call, you may need to translate some of these numbers. They can be somewhat regionalized, but you can see that, on the low end, some adult daycare, if you're personally taking care of a family member, a friend, and you need a break, this is ultimately adult daycare services is going to be kind of general care. There is some oversight. And the average cost is in the line of, $19,000 to $20,000 per year on the low end. As you kind of move over to the right for, folks that may have more of those cognitive diseases, whether it's Alzheimer's or dementia, and need kind of that around the clock coverage. We can see that in Massachusetts, the average stay for a semi-private room, almost $12,000 to $13,000 a month. And then really for a private room, it can go up even further from there. So that just hopefully can paint a picture of, when we talk about, the potential future costs of what these types of coverages can impact our net worth and our estates, they can be significant numbers. And something that Mike also mentioned when it comes to both the cost of care, but also the duration of what a stay looks like. The national average at the current moment for a male that needs some type of coverage is just over 2 years. For females, it's over 3 years. And when you ultimately compound these numbers, whether it's just in the short term, $151,000 at a 2 or a 3 year stint, we can see how quickly we can really spend down some of the assets that we've, worked our entire lives accumulating. The other component to it, although over the last year or 2 years, really since the pandemic, the inflation numbers are relatively low, tied to the cost of living increases within the healthcare space with nursing home care. But if we were to use kind of a standard 3% inflation factor for someone that's 65 today that may need care in their mid 80s, we can see that, the growth and the compounding of what these costs could look like are upwards of $275,000 in annual costs. So certainly not insignificant, somewhat daunting with the unknown of whether or not we'll need it. So as we kind of transition through, the presentation, we'll talk about ways to protect against these potential costs, or at least kind of reiterate the fact that these are real. As Mike mentioned with the stats, more people than not do need some level of coverage at some point in their lives. So just being prepared to embrace that is something that should at least be in the minds of folks as it relates to their financial plan. Whether you choose to take action or not, can afford to take action, is obviously indicative of the resources that you've accumulated. In terms of how will you pay for long-term care, whether that's now or in the future, out of pocket. So we'll get into all three of these in more detail. So out of pocket could also be viewed as self-funding. So you're basically paying as you go. Governmental programs, I think that's a very common theme that we talk to clients about, in terms of them just being under the impression that there are going to be programs that are just going to step in and pay for this coverage. I can't say at a point blank matter that may not be the case, but at a global level, there are certain things that have to happen before these types of programs ultimately kick in. And then really the last one, there's different types of long-term care insurance that's available in the marketplace. I think in conversations with clients, this is the area of financial planning, kind of in addition with estate planning, that folks want to talk about the least, because of the expenses involved, because of, I think, just the psychological thinking of, I hope I never have to go into one of these facilities. But it really goes back to, the statistics out there that, more often than not, someone's going to need some level of coverage. So I'll start off with the first one, probably the easiest to comprehend and understand. It's the kind of quote unquote, you pay as you go, and you ultimately self-fund what the future costs of long-term care would be, whether it's in, a skilled nursing facility, adult daycare. You're ultimately liquidating assets or utilizing income in retirement to pay for these expenses. So I think the benefits to this are for folks that, go throughout their retirement years and never need coverage and never have an LTC event. You obviously have avoided paying any type of insurance premiums. You've avoided paying down your estate. But on the kind of drawback side of it, ultimately, this comes down to legacy planning. If you have a 2 or 3 year stay, even with $1 million estate, you can see how quickly these assets will be spent down and will obviously dilute or minimize what assets you're able to transition to a next generation or beneficiary. And then also kind of the pay as you go. If you do ultimately run out of assets, Mike's going to go into in the next couple of slides where some of the governmental agencies in state-run governments step in to help with the cost of coverage.
Yeah. So another thing I think very common that we're hearing from clients, individuals we speak to about long-term care is government programs that may or may not be able to help them. And there's really two kind of distinct areas where people can get some form of coverage in terms of long-term care coverage. The first is Medicare. So most of us probably are familiar with Medicare to some degree. That would be the federally program on health insurance that some of you may be enrolled if you're in retirement already, or you will be enrolling when you get into retirement age 65. That does have some provisions that will cover a portion of long-term care stay, but it is just that. It's a portion of the coverage, and it will cover a portion up to 100 days. And then after 100 days, it stops completely. There's no coverage after 100 days. And, looking at the statistics, most people who are going into a long-term care event, it is longer than the 100-day period by a significant amount. I think Dan mentioned it earlier. For men, it's over 2 years and women over 3. So drastically outpacing that 100-day period. So given the cost we've seen earlier, it leaves a pretty significant gap there in coverage. The other side of that is Medicaid. I think this is another thing that people think might be a good solution for them for long-term care coverage. And there's some kind of misconceptions out there that I think it's important to clarify. So Medicaid is it's really a safety net program. It's a last resort for medical coverage, and that's really how it's designed to be used. It's not something that it's ever designed for someone to bank on using. It truly is a last resort federal and state funded program. So it varies on state to state, but for most people, they would have to draw down their assets, their income very significantly to the degree of single thousands of dollars. $2,000 or $3,000 is how much you'll need to reduce your assets, your net worth down to in order to even qualify for Medicaid. And once you do qualify for Medicaid, it really is not a lot of freedom associated with this. You won't have a lot of say in terms of the nursing home you're sent to, the type of facility you are going to. It is a needs-based program, and it's also a next available bed program, meaning if you it's not, if you live in, let's say, Boston, where we're headquartered, you're not automatically sent to the Boston facility. You'd be sent to the next available bed within the state of Massachusetts. So for most people, they want to stay either at home in a long-term care event or as close to their family, as close to home as possible. And that unfortunately will not be possible with Medicaid. So those are two important things we kind of wanted to go over, dispel a little bit of maybe some misconceptions around those. Then the last thing, the third option is long-term care insurance. So this type of insurance is really kind of for the planners. It does give you a little bit more freedom as to how you can receive your care, kind of along those transitional periods we talked about earlier, be it staying at home, moving into facilities. But like everything here, it's not a one-stop shop. There's a few different flavors of insurance. There's what we call straight or traditional long-term care insurance, and hybrid long-term care insurance, which we'll get into in just a moment. But before we do that, I'll turn it back over to Dan to talk a little about some people who this might be good for.
Yeah, sorry about that, Mike. I jumped the gun.
That's okay.
Transitioning. But as Mike mentioned, before we go into the different types of policies that are available on the marketplace, I think from a financial planning standpoint, just asking yourself, who are the individuals out there that are actually buying, this type of policies for protection? Generally, it's going to be at the most simple level, people that are planners, people that are thinking about the future, people that are thinking of what their future wishes are in terms of leaving a legacy to family, protecting assets that they've worked their whole life accumulating. So I think those are generally the first individuals that are going to be having these conversations of, what can I be doing? What are going to be the best courses of action? Regardless of your estate size, I think everyone's going to fall into a different situation, probably emotionally and psychologically, as to what may be best for them. For people that are looking to buy insurance, generally between the ages of 45 and 65 is kind of that sweet spot as to when you're going to really start looking into whether or not coverage makes sense for you. A lot of the carriers out there right now, they don't even write policies on individuals that are under the age of 40. So 45 to 65, generally it can be when you're in your higher earning years. So you may have the cash flow to support the cost of policies. And generally, up until age 65, if you haven't gone through a significant healthcare event at that point, and you could potentially wait into that latter end of the window, it'll obviously shorten the time frame that you're paying premiums. But really what we see in the marketplace, once you're past the age of 65, obviously the likelihood of having some type of medical event that could eliminate you from underwriting, and the fact that you are just older in age, insurance carriers are either going to have significant increases on the premiums you pay, or you may find difficulty in making it through the underwriting piece, which I'm going to go into next. And then obviously kind of the last piece is people that don't want to be a burden on their family. So if your children or family members are still working, they may not have the time or the wherewithal or the resources to take time out of work or retire early to provide the level of care that you deserve. So I think this should cover in a broad standpoint kind of the types of individuals that we're generally talking to that are really thinking about whether or not this is right for them and evaluating what may be the best course of action. When it comes to long-term care insurance, it's very similar in the mindset of, for folks that have gone through, when you had children or bought a home and you were looking for family protection, you may have bought an individual life insurance policy, whether it was term insurance, a whole life policy. And these policies can really be customized in a lot of different ways that can ultimately dictate what the future benefits will look like. Or for folks that are trying to be more of the cost control mindset, you can build a policy that may not break the bank. So ultimately, the premium that goes into the policy is going to dictate what the future benefits will look like, or vice versa. So I'm going to cover kind of in the next couple of slides what standalone long-term care insurance policies look like. And then I'm going to transition to Mike, who's going to cover more hybrid policies that have a little bit more bells and whistles. But as a firm, we see a little bit more value in just based on how they're designed, the benefits that they offer, and the protection that's provided to you as a potential customer. So the first step is the amount of the policy will pay on a daily or monthly basis. So ultimately, each policy is going to be designed to pay some different level of care for a future event. So it could be designed to pay $10,000 a month. It could be designed to pay $5,000 a month. And based on that, given the figures I was showing earlier, that may not cover the full cost of a skilled nursing facility. But ultimately, this is an insurance. It doesn't have to be designed to pay for the highest possible amount you could ever imagine. This may be a policy that you design to cover a portion or at least offset some of the potential future costs. Also, you can control how long that these benefit periods will last. So typically the longest that you'll see any policy designed to cover for is up to about a 5-year period. You can choose the policy that will pay for up to a year of coverage, up to 3 years of coverage, all of which will go back into kind of the calculation of what the cost and what the premium will look like. The elimination period, this is similar to a deductible with insurance. This is the number of days or number of months that you have to wait before coverage kicks in. So I think kind of a standard elimination period can be anywhere from 3 to 12 months, meaning if you were to go into, a nursing home, the policy would not necessarily respond until you have self-funded that number of months or that number of years. So that's another way where you can often control the cost. And then really, I think the most important one, and I mentioned this earlier when I outlined what the cost of nursing home coverage could be even 20 years from now, you can generally tie an inflation rider to these policies so that the premiums you pay, the benefits ultimately, the premiums may be higher, but the benefits in the future will ultimately be inflating at some predetermined rate, whether it's a 3% inflation rider, a 5% inflation rider. But the one thing I did want to mention when it comes to these standalone policies, I think the thing that folks oftentimes overlook, and this is something that's happened quite a bit over the last several decades, is whether or not the premium you're paying is guaranteed or non-guaranteed, meaning that in the future, at a global level from a carrier standpoint, whether or not they can increase the premium that you're paying annually. We try as a firm when we're designing these policies to explore the carriers that do offer the guaranteed rates so that you don't pay into this policy for the next decade or 2 decades. And then all of a sudden it gets to a point where you may need the coverage the most, but the premium simply becomes much too unaffordable, which could cause a potential lapse in the policy. So going into kind of figuring out the premiums, there's various areas that control what the potential cost of coverage may look like. Some of them are obviously fairly obvious. The younger that you ultimately seek coverage, the lower premium that you're going to pay. But if you do a calculation, you're obviously more likely than not going to be paying those premiums for a longer time period. So just because I showed, 45 to 65 being the sweet spot of when you want to be exploring this, if you're extremely healthy at 45 and you're willing to take some level of risk, it doesn't necessarily mean that you need to go out and get coverage right away. Health is a big factor. Typically, when we go through kind of the underwriting for long-term care insurance, there are some what are called knockout questions that do eliminate people's ability to get through underwriting, whether it's, significant heart disease, cancer, other items that may be in your health history. They may eliminate you right out of the gate based on the carrier's requirements. But it is subject on a standalone basis to a health exam. So anything in your medical records, an interview with a nurse when you're going through the application, those are all going to dictate whether or not you're able to get coverage. So I think what we talk about a lot internally is, we have conversations with clients. They see the value in having some level of protection. And when we get to kind of what I call field goal range of really selecting carriers and going through the more formal process, we may find out that they're either eliminated from getting a policy or the premiums are going to be substantially higher. So the lifestyle criteria on the left, those are going to dictate kind of what you can expect to pay. And then really in terms of controlling premiums, I talked a lot about this in the previous slides. It's how you design it. What type of benefit are you looking for in the future? How long of an elimination period are you willing to take on? Whether or not you want to tie an inflation rider to it. These policies can be designed in a lot of different ways. So the cost can be obviously all over the place, and that will go directly into the benefits that you'll receive in the future. And then before I kick it back to Mike to go into some of the hybrid policies, I may have covered this just speaking off the cuff on other slides. But in terms of applying for life insurance or long-term care insurance, there's an application that's obviously going to be submitted to the carrier that is going to be answering obviously medical questions. It's going to be answering lifestyle questions, and really the medical records typically are what really drive this whole process. So the application is more to design what type of policy you're looking to get. Once that is done, that does not mean that you magically have coverage. So there will be a thorough review of the records. There may be a phone call with a doctor to go over what is in those records. And then typically what we've seen in recent years, specifically with the hybrid policy, part of the application process is an actual phone interview with the potential buyer and a nurse that works for the carriers. There could be some additional blood and urine exams. So on the long-term care standalone policies, I mentioned through the underwriting, the premiums are going to be dictated by the health, the age, and things of that nature. Mike will probably go into when he covers the hybrid policies. They have more of what I call kind of the cliff method. The rates are the rates. It's you're either going to get approved for coverage or you're going to get denied. So that's ultimately one big difference between the standalone and the hybrid policies that he's going to go into right now.
Yeah, and I think one of the really common questions when we're going through this process with some of the families we work with is what does the benefit period look like? Like if I have a long-term care event, how do I actually get this benefit? How do I get the payment out to the carriers? How do I know when the kind of the taps turned on in terms of my benefit period? I'm sure we've all dealt with, healthcare carriers before trying to get a medical procedure approved or something like that. So there's rightfully so kind of a little bit of animosity around that. And thankfully with long-term care insurance and coverage and the benefit, it's a lot more standardized and it's a lot simpler. So really with this, it is kind of falls under HIPAA and it's all defined that way. So it goes back to those ADLs, the activities of daily living we had discussed before. So really the criteria comes in two flavors, like we talked about before, the physical and the cognitive. For the physical, all that needs is a licensed physician needs to certify that you're unable to perform 2 out of the 6 ADLs. and that they expect that to last for a minimum of 90 days. And to be clear, this can be your primary care physician. It does not have to be an insurance doctor, anything like that. It is any licensed physician. And then the other side of that is the cognitive impairment, right? The Alzheimer's, the dementia. A diagnosis on those two would also satisfy those, even though you may not have any of those ADLs. The severe cognitive impairment does satisfy that requirement and kind of turns on the tap in terms of the benefit you'd be receiving for the long-term care. Now we'll jump a little bit into the hybrid policies themselves. So hybrid policies work a little bit different than those traditional policies Dan was talking about before. And the simplest way to kind of define the two of them is a traditional policy. You can almost think of it as like your homeowner's insurance, your car insurance, where you have the policy, it renews every year, you keep paying it maybe annually, quarterly, and those rates can change based on actuarial numbers, based on your profile. Those numbers can change. They're not guaranteed to stay where they are. Where a hybrid policy works a little bit different, where a hybrid policy, the reason it's called a hybrid policy is it's technically, and it's really life insurance, or it technically can be an annuity policy as well. So it's a life insurance kind of chassis with long-term care built on top of it, where the purpose of it is not to provide for that death coverage with the life insurance. The purpose is for the long-term care coverage, but the life insurance component adds some kind of key additional bonuses that we'll talk about on the next slide. So with that, it does still have the same long-term care insurance. The actual benefit payout works very similar to how Dan was referencing before, with elimination periods, the benefit duration. It's all very customizable with that in the same degree. But one of the two big differences is there's a death benefit associated with it. So with traditional long-term care, if you never use the policy, if live your full retirement years with no long-term care event, you pass away, you essentially get kind of nothing out of that traditional policy. Whereas with a hybrid policy, there is albeit kind of small death benefit associated with it that we would kind of characterize more as a return of premium, right? It's essentially approximately the amount you've paid into the policy, you would then get back at end of life as a death benefit. Whereas if you use the long-term care insurance, you would not get that death benefit, but it is there as kind of a return of premium. So I think that kind of resonates with some people who might say, well, what if I never use this coverage? I'm spending all this money on the insurance coverage, but I'm not using it. So it helps alleviate that. And another great bonus of these hybrid policies is, again, there's a lot of different ways to structure it. You can pay X amount of dollars in a guaranteed premium through the rest of your life, or you do have the ability to do paid up insurance. So that can be in a single premium, or in some people will do a 10-pay premium, which allows you to kind of get that premium paid up in that single year or the 10 years, where then you no longer ever have to pay any sort of premium into the policy. It's fully paid, it's issued, which I think gives a lot of peace of mind for people, especially we talked about the kind of key ages where someone might want to think about this, the 50 to 55, especially, those folks are absolutely kind of the key people who should be thinking about this, because you can fund it during your working years, be it the 10-pay or that single premium. And then once you get into retirement, the policy is completely paid for, that you at no point will you have to go back and pay any additional premiums. You have the policy in place and you really have that peace of mind, right? Of coverage. You don't need to pay anything else. You have the LTC event is kind of, it's a checkbox, right? It's all paid up. It's all squared away. So I think it's a great solution for kind of getting that peace of mind. You can tell your loved ones, here's the policy. If something happens, just put it in force, and that's all you really need to know. On the last thing I will say too is these policies work very similar in terms of medical underwriting. I think Dan said it really well, where it's kind of like a cliff where there's not much in terms of rating your health profile. It's really more either you get it or you don't. And it's very customizable as well in terms of how much you want to pay in, gets X dollars. If you want to pay X more, you'll get kind of X more on the benefit side. So it's very linear in the way it works, but it does really come down to your age, those kind of inflation riders you attach there. So it's kind of difficult to say paying X amount today will get you this amount in 20 years or in retirement. But
Mike,
with
there was
that
going to
being
be one
said-
thing. I was going to just add one thing. In the hybrid policies, one thing that can vary from carrier to carrier is how the policies actually respond. So in the simplest of ways is ultimately once you have a long-term care event, policies can be designed to just start paying a monthly available amount immediately. So whether it's, $5,000 of expenses that you're experiencing on a monthly basis or 12 grand of monthly expenses you're incurring, the policy is just going to start kicking out a monthly payment to you without having to provide receipts. It's just if the policy is designed to pay 12 grand a month, it's going to pay 12 grand a month regardless of what you're actually experiencing. There are also other policies that work on a reimbursement basis, whereas the expenses start to be incurred. Somebody, a loved one, is going to be responsible for ultimately submitting receipts, showing proof of coverage, and ultimately the policy will reimburse those expenses. So those are just two differences in terms of how the policies may respond. So something that you want to be aware of ahead of time, just so you know ultimately what's going to happen if an expense or if a need is going to come upon you.
Yeah, well said. And then I think we've got a few questions in the chat here. I'll try and grab a few. If we don't get to everyone, we'll definitely be kind of reaching out retroactively. There will be a post, but I did see a few that I wanted to kind of address. I think they might be good broad questions. And the first was, could an applicant find out in advance if their health history would exclude them from coverage? That's a great question. Absolutely, yes. Whenever we are working with families, we have kind of a simple, it's a quick one pager, just kind of a health profile. And what we can then do is take that out to kind of the carrier marketplace and anonymously submit that and say, hey, essentially kind of say, hey, in theory, could this person get coverage? And then they can kind of give us the presumptive yes or the presumptive no. So that will kind of give us, it's not an absolute yes, an absolute no, but it will kind of give us a compass of where we are headed.
Question that came in, what carriers are typically utilized for long-term care? So something that you've probably are well aware of that you've seen over recent years, a lot of carriers and insurance companies have left this space. So pretty much either determined from their inception to date of how they price policies, it was a market that they no longer wanted to maintain an existence or a presence. In recent years, I think there's a handful of names that are probably what I would call the top tier carriers that we would explore. And it's typically Lincoln, Mass Mutual, Securion, which is Minnesota Life, Nationwide, and Mutual of Omaha, I would say, are the major players at this point in time on the open market. Another question was, is eligibility for Medicaid based on individual or couple's income assets? So it is based on a couple, but the one thing that we may not have mentioned is it does not include the primary residence. So it's really more of the investable assets, cash, retirement accounts, brokerage accounts. Those are generally the assets that need to be spent down before you're eligible for some of that state-sponsored care.
And then I think we'll do one more question and then we might have to wrap up here, but I think this is a good question as well. does a hybrid policy typically cost more than a traditional policy? So I would say this is a pretty tricky question. It's really hard to say one or the other. With a hybrid policy, you definitely get the advantage of kind of knowing the future, right? With a hybrid policy, you can say it's a 10 pay, a single pay, and that's what you'll pay no matter, come hell or high water, no matter what happens, that's what that cost will be. With traditional, because you're paying it each year and those premiums can change, it really would be a matter of kind of chance or a matter of when those LTC events occur and how much that cost change.
So there's a couple more that I think I can answer relatively quickly. Can the policy limit or choose who I elect to provide care? Can they decide who my home care agency is? So if you have life insurance coverage, you as the consumer can choose ultimately where to seek coverage, assuming there's availability, at the facility that you're hoping to be. Based on which facility or which level of coverage you're going to get will obviously determine how much of the policy will ultimately pay for. So if you're at a higher cost facility and you had a smaller level of coverage, it may not cover everything. Whereas if you have adequate coverage and you need minimal care, it may potentially pay for everything. At what level of assets would you suggest that LTC insurance is not necessary? Assume that marital status, potential for surviving spouse will change this. So that's a tricky one to answer because at the end of the day, if you have a very large estate, you could obviously create the argument that you have the ability to potentially self-fund. But there are those obvious situations that are kind of the less unique, but it's not totally out of the question or ordinary for someone to have a significant stay well beyond that 2 or 3 year period, which we mentioned are the average. I grew up with an individual whose mother was in basically a skilled nursing care for over 10 years with Alzheimer's. And obviously, if you look at the cost of what that ultimately looked like over that duration of a time, it's significant. So I don't think there's a magic number where I could ever say there's absolutely no reason you need insurance coverage. But obviously, the larger the estate, the larger amount of available resources kind of dwindles the need for potential coverage.
I think that might be kind of all we have time for here. I want to thank everyone for their time. We'll definitely, if anyone had any additional questions in the chat we weren't able to get to, we'll be reaching out with answers. But again, thank you, everybody. We appreciate your time.